Welcome to White Paper Podcasts, where our hosts Heather and Andre discuss a wide variety of informational sources, making them easy to understand through an informative and entertaining format. In today's podcast, Andre and Heather discuss JP Morgan's recently published study called The Guide to the Markets. This podcast lasts approximately 14 minutes.
All right, so we're diving deep into market trends today, and we've got a great tool for that, the JP Morgan Guide to the Markets. It's got a ton of data, so let's see what kind of stories it can tell us. I'm thinking we start with like the big picture, the S&P 500. As of September 30th, 2024, it's sitting at a forward PE ratio of 21.5x.
Okay.
Now, I know that might sound like a bunch of jargon, but basically it's telling us the market is looking a little pricey, don't you think? Especially when we remember that back in 2000, during the dot-com bubble, the market was considered similarly expensive right before things went south.
Yeah, that's right. The PE ratio is a key valuation metric. It essentially tells us how much investors are willing to pay for every dollar of a company's earnings. So a high PE, like we're seeing now, suggests that investors are really banking on some significant earnings growth down the line.
Okay, so they're betting on the future. But is that a good bet? I mean, are we potentially setting ourselves up for disappointment if those expectations don't quite pan out?
Not right. That's the big question.
And, the guide doesn't exactly calm those fears when you look at the KP ratio.
Yeah.
It's currently at a pretty dizzying 35.24x.
Yeah.
Significantly higher than its historical average. Makes you wonder if we're in bubble territory again.
Yeah, the KP ratio, or Shiller's PE ratio, as it's also known, is a really useful tool for getting a handle on market valuation. Unlike the standard PE ratio, which just looks at 1 year of earnings, KP takes a much longer view. It uses a 10-year average of earnings.
Yeah.
And that helps smooth out any of those short-term blips and gives us, I think, a better sense of whether the market is truly overvalued or undervalued.
So if SAPE is flashing red, should we be worried?
Well, not necessarily. I wouldn't say that's a screaming siren, but maybe more like a yellow light urging caution.
Okay, proceed with caution. Got it. But high valuations don't always equal an immediate crash, right?
Right.
What about those actual earnings that are driving these valuations? The guide projects S&P 500 earnings growth for 2024 and 2025, but it seems like profit margins are playing a pretty big role in that growth. Is that a concern?
Yeah, that's where things get a little interesting. While earnings growth is generally a positive sign, of course, we have to ask ourselves, how much of that growth is truly sustainable? And the guide points out that a significant chunk of the projected growth is actually reliant on companies expanding their profit margins, which, it's not always easy to do that sustainably in the long run.
Right. It's like trying to squeeze the last bit of toothpaste out of the tube. At some point, you're going to hit the bottom.
Yeah. Exactly. We have to think about things like wage growth and input costs. If those start to rise, which is a real possibility in this economic environment, it becomes much tougher for companies to maintain those really high profit margins.
And let's not forget about competition and new regulations, right? All those curveballs the business world loves to throw at us.
Oh, yeah, for sure.
And speaking of big players, we can't ignore the elephants in the room, or I guess, according to the guide, the Magnificent Seven.
Right.
Apple, Microsoft, Amazon. These giants are not only shaping the tech world, but they're having a massive impact on the S&P 500's overall performance and earnings. In fact, the guide points out that the top 10 companies now make up I can't believe this, but 35% of the S&P 500's market cap.
It's huge, and it really highlights a growing concern about market concentration. While these companies are, no doubt, powerhouses, their sheer size does create a potential vulnerability for the market as a whole. If one or two of these titans were to stumble,
the ripple effect would be huge.
Exactly.
It's like putting all your eggs in a few very large, very expensive baskets and hoping none of them drop.
That's a great way to put it. And it's not just about the market risk. This level of economic concentration tends to attract regulatory scrutiny as well. We're talking antitrust concerns, data privacy issues. All these factors could really impact these companies and, by extension, the broader market.
So we've got this concentration issue, we've got high valuations, and we have questions about the sustainability of earnings growth. It really makes you wonder, what happens if we broaden our horizons a bit? Look beyond the S&P 500. What's going on in some of those other corners of the market, like small cap and value stocks? What about them? And what about global equities? I always hear about all these opportunities in emerging markets, but then you hear about the risks, too. It's kind of confusing.
Yeah, emerging markets can be a bit of a mixed bag, for sure. I mean, they definitely offer, the potential for high growth, but they often come with more volatility. And political risks can be a factor too. And with the US dollar being so strong right now, it makes investing in emerging markets even more complex.
Right. Makes sense. The guide also mentioned something about international developed markets like, Europe and Japan. Are those worth considering too?
Definitely. What's interesting is that valuations in those markets are actually looking more attractive compared to the US right now.
Yeah.
So it could be a good time to think about diversifying geographically,
Hmm.
especially if you're a little unsure about those high valuations we're seeing here.
Diversification. Right. Don't put all your eggs in one basket. That's what they always say.
Exactly.
And speaking of diversification, we got to talk about the fixed income side of things too. Bonds. The guide had a whole section on bonds. And I'll be honest, that's always been a bit of a mystery to me. I know interest rates have been all over the place lately,
Yeah.
and I've heard that's good for bonds, but I'm still a little fuzzy on the details.
Okay, so basically when interest rates go up, like they have been, newly issued bonds become more attractive to investors because they offer higher yields.
Sure.
It's like getting a better return on your savings account.
Okay, so higher interest rates equal better returns for bond investors. Got it. But then I also remember hearing something about bonds losing value when interest rates go up. How does that work?
So that's true, but it mainly applies to bonds that you already own, existing bonds. Let's say you bought a bond a while back, maybe last year, with a 2% yield. Now interest rates have gone up, and new bonds are being issued with a 4% yield. Well, your existing bond with that lower yield is going to be less appealing to investors, right? So its market value could decrease.
Oh, okay, so it's all relative, new versus old.
Yeah.
Higher interest rates make new bonds more attractive, but they can hurt the value of those older bonds. Gotcha.
Exactly. But, within the bond market, there are also areas that offer even higher potential returns, although usually higher risk comes with that too.
Mhm.
The guide specifically mentioned high-yield bonds. Those might be worth a look.
High yield bonds. Okay, those sound interesting, but maybe a little risky. What's the deal with those?
Yeah, you got it. High-yield bonds are basically bonds that are issued by companies that have, let's say, lower credit ratings.
Lower credit ratings, okay.
So these companies have a higher chance of defaulting on their debt,
Mm-hmm.
meaning they might not be able to make their interest payments or even repay the bond's principal when it comes due.
So higher potential reward, but also a higher chance that things could go not so well.
Exactly. High-yield bonds can be tempting with those juicy yields, but they're definitely not for the faint of heart. They need a higher risk tolerance. And you really got to understand the companies that are issuing those bonds.
Do your research, right?
Yes, always, always.
Risk tolerance. That kind of brings us back to something we were discussing earlier, value investing. The guide mentioned that value stocks, those companies that are often kind of overlooked, are currently trading at a pretty significant discount compared to, those flashy growth stocks. So for someone like me who's, intrigued by this whole idea of maybe uncovering a hidden gem in the market, what should I be thinking about with this discount? Is that like a screaming buy signal, or is there more to it?
That is a question that a lot of investors are asking right now. Why don't we take a look at what the guide says about the energy sector, for example? It highlights that energy stocks, even though they've been kind of out of favor in recent years, are trading at a big discount to the overall market. And that's especially interesting when you consider that these energy companies are actually benefiting from these higher energy prices we're seeing, as well as strong global demand.
So even though they're making money, the market isn't really reflecting that in their stock prices. That does sound like a classic value investing scenario.
Right. Now, remember, there's always a reason why certain stocks or sectors trade at a discount. With energy, it's partly because there's this long-term shift happening towards renewable energy sources. So there are concerns about, the sustainability of fossil fuels.
Right. The whole ESG thing, environmental, social, and governance factors. Investors are definitely paying more attention to that these days. And I guess maybe that's putting some downward pressure on energy stocks, even if their financials look pretty good right now.
Absolutely. So while that discounted energy might be a great buying opportunity for value investors, you have to weigh those long-term risks and think about whether those companies have a solid plan for navigating this energy transition.
Got it. Thorough research, as always, is key. We've covered a lot of ground here. Valuations, earnings, market concentration, different sectors, even some investment strategies. But let's zoom out for a second and look at the bigger picture. The guide has a whole section on the economy, and I'm curious about how things like GDP growth, inflation, and of course, interest rates might play into all of this. The market stuff we've been talking about. I gotta say, when I think about the economy, It feels a little bit like I'm trying to predict the weather sometimes.
Yeah.
It's unpredictable, so many different factors at play. The guide seems to paint kind of a mixed picture of where things stand right now. Like, it mentions moderate GDP growth, which is good, right? But then there's inflation. I know it seems to be cooling down a little, which we all want. But then you hear about core inflation. I'm not really sure what that even means.
Yeah, you've hit on a key point. Inflation is this weird puzzle right now. Overall, inflation does seem to be getting better. But you're right, core inflation, which basically takes out those volatile food and energy prices, well, it's being a bit more stubborn than we'd like.
Stubborn inflation. That's not good, is it?
Not ideal.
And doesn't that make the Fed's job even harder? Because they're the ones who have to walk this tightrope between keeping inflation under control without completely tanking the economy.
Exactly. The Fed has a really tough job right now, and they've been raising interest rates a lot. Pretty aggressively, actually, to try to combat inflation. But if this core inflation doesn't play ball, well, they might have to keep those rates higher for longer than any of us would like.
Which, of course, affects both the stock market and the bond market, too, right? We were talking earlier about how rising rates can really impact bond yields and valuations. But what about stocks? How do higher interest rates play into that?
Well, higher interest rates can actually kind of drag down stock prices
Yeah.
for a couple of reasons. First, it makes borrowing money more expensive for companies, right?
Right.
Which can put a squeeze on their profit margins. And on top of that, those higher rates can make bonds suddenly look like a much safer, better investment compared to stocks.
So investors might start moving their money out of stocks and into bonds. It's all connected. One big financial ecosystem.
Okay, well, we've covered a ton today. From those high valuations in the S&P 500 to those potential opportunities we talked about in value stocks and even in international markets. We even explored bonds and the Fed's ongoing battle with inflation. It's a lot. But before we wrap up, I got to ask, what does all of this actually mean for the average investor out there? Someone who's just trying to make sense of it all and hopefully make some smart decisions with their money. What are the key takeaways they should keep in mind?
I think that's a great question. At the end of the day, the whole point of this deep dive is to give you, the listener, the tools and the knowledge to feel more confident in your investment decisions. So let's distill everything we've talked about down to a few, main points. First and foremost, diversification is key. Don't put all your eggs in one basket, especially in this market. Spread the love.
Yeah, stocks, bonds, maybe even a little real estate or commodities. And don't just focus on one sector or one company.
Or even one country.
Exactly.
Yeah.
Think outside your usual box.
Okay.
Okay. Second thing to remember is this. Investing is a marathon, not a sprint. Okay?
It's a long game.
Yes. The market is going to have its ups and downs. It always does. It's so easy to get caught up in all that short-term noise and those day-to-day fluctuations. But try to keep your eye on the bigger picture.
Yeah, I'm definitely guilty of checking my portfolio way too often. It's a roller coaster of emotions, let me tell you.
And it can lead to some impulsive decisions that maybe in hindsight weren't the smartest moves.
Definitely been there.
So, take a deep breath. Remember your long-term goals. And remind yourself that time in the market is often more important than trying to perfectly time the market, which, by the way, is basically impossible.
Yeah, no one has a crystal ball, unfortunately. But staying informed is still important, right?
100%. This is an ever-changing landscape, so keep learning, keep those questions coming, and never stop trying to expand your knowledge. That's what these deep dives are all about, right?
Right. Well, before we sign off, I know you like to end with one of your trademark thought-provoking questions for our listeners. So hit me with it. What's the big question they should be thinking about this week?
So you've now heard all the facts and figures. We've analyzed the trends together. You've got all these great insights from the JP Morgan Guide to the Markets. So here's the real question. What's your story going to be? What story are you going to write with your own investments? Are you going to chase those high growth opportunities in the S&P 500? Even with those high valuations we talked about? Will you be digging for those diamonds in the rough in the value stock world? Or maybe set your sights on those international markets? The choice is yours. But choose wisely.
I love it. It's not just about understanding the market. It's about understanding yourself, your risk tolerance, your goals, your gut feeling. It's about making the market work for you.
Yeah.
Which is powerful stuff. I know I've got a lot to think about. Thanks for guiding us through all of this.
It was my pleasure. Until next time, happy investing.